Welcome. Today, we are diving into an exciting topic that is going to help you take your trading game to the next level. We are going to learn how to read price action and volume together. This is a powerful combination that can give you an edge in understanding the market. By the end of our discussion today, you will know how price action and volume work together to reveal trends, breakouts, and potential reversals. Trust me, you do not want to miss any part of this, because these insights could change the way you look at trading. Before we dive deeper, imagine being able to see the invisible tug of war between buyers and sellers unfolding in real time right in front of you. That is exactly what understanding price action allows you to do. Let us start with price action. You might be wondering, what exactly is price action? In simple terms, price action is the movement of a security's price as it changes over time. It is like watching a chart where the price moves up or down, giving you an idea of how buyers and sellers are interacting in real time. Traders love using price action because it is not delayed. There are no filters or lags, just raw movement that shows the immediate psychology of everyone in the market. When you look at price action, you are seeing what traders feel, how they react, and the collective behavior at any given moment. To truly understand price action, you need to become familiar with key chart patterns that repeat over time. These patterns give us clues about what might happen next. One important pattern is the double top. A double top looks like the letter M on the chart and signals that the price might be about to reverse from an uptrend to a downtrend. When price tries to rise twice but fails at the same level, it shows that buyers are losing control and sellers are ready to take over. On the flip side, a double bottom looks like the letter W and indicates that the price might be about to reverse from a downtrend to an uptrend. When price fails to break lower twice, it suggests that sellers are losing strength and buyers might push the price back up. Another key pattern is the head and shoulders. This pattern is made up of three peaks, where the middle peak is the highest. It usually signals that an uptrend is coming to an end and a reversal might be about to happen. Traders look for a break below the support line, called the neckline, to confirm the reversal. Similarly, an inverse head and shoulders pattern shows that a downtrend might be ending and the price could soon move up. Triangles are also common and important patterns. An ascending triangle has a flat top and rising lows, showing that buyers are becoming stronger and pushing the price up to a key resistance level. When the price breaks above this resistance, it usually signals a strong move higher. A descending triangle, on the other hand, has a flat bottom and falling highs, indicating that sellers are gaining strength. When the price breaks below the support level, it often leads to a strong downward move. Flags and pennants are continuation patterns that show a brief pause before the trend continues in the same direction. A bull flag forms after a sharp rise in price, followed by a small downward sloping channel. This shows that the market is taking a breather before the uptrend continues. A bear flag is similar, but it forms after a sharp decline in price. Pennants are similar to flags, but they have converging trend lines that create a small triangle. Both flags and pennants indicate that the market is likely to continue in the same direction after the pause. Wedges are another important pattern. A rising wedge forms when the price makes higher highs and higher lows, but the lines are converging. This pattern often signals that an uptrend is losing momentum and a reversal might be coming. A falling wedge, where the price makes lower highs and lower lows with converging lines, suggests that a downtrend is losing strength and a reversal to the upside might happen. Understanding these chart patterns can help you make better trading decisions. When you see these patterns form and combine them with volume analysis, you get a clearer picture of what the market might do next. Always remember that volume is key to confirming these patterns. If the price breaks out of a pattern and volume spikes, it confirms the move. If volume is low, the breakout might not hold. Now, let us talk about volume. What is volume and why does it matter so much? Volume represents the number of shares or contracts being traded during a certain time. Think of it like a measure of how much interest there is in the market at any moment. When there is a lot of volume, it means a lot of traders are involved. When volume is low, it suggests that fewer traders are interested in making a move. You need to pay attention to volume because it can help confirm what price action is telling you. When the price moves up or down, you want to know if a lot of people are participating in that move or if only a few are. This can tell you whether the trend is strong or weak. All right, let us get into how to use these two powerful tools together. Imagine you see prices going up, and you also notice that the volume is going up. What does that mean? It means the buyers are confident and the trend is likely strong. More and more traders are backing that upward move, which is usually a good sign that the trend will keep going. This is especially true when the price action is forming recognizable chart patterns like ascending triangles, bull flags, pennants, or even cup and handle patterns. For instance, an ascending triangle with increasing volume indicates strong buyer interest, which often leads to a breakout above the resistance level. Ascending triangles are bullish continuation patterns that demonstrate buyers' strength, especially when volume builds up as the price approaches the resistance line. A breakout with a surge in volume is a clear indication that buyers are in control, and the uptrend is likely to continue. Similarly, a bull flag with rising volume shows that the brief pause in price movement is temporary and the uptrend is likely to resume. A bull flag forms after a sharp price increase, followed by a period of consolidation that drifts slightly downward or sideways. This pattern represents a pause for the market to catch its breath before continuing higher. When you see a surge in volume during the breakout from the flag, it is a signal that buyers are taking charge once again, making this pattern a reliable continuation indicator. Pennants are another continuation pattern to look for. They are similar to bull flags but have converging trend lines that form a small symmetrical triangle. A breakout from a pennant with rising volume signals that the market is ready to move in the direction of the prior trend, and it is often accompanied by strong momentum. Pennants can form after both upward and downward movements, and the direction of the breakout will usually follow the preceding trend, with volume being the confirming factor. Another powerful bullish pattern is the cup and handle. This pattern resembles a teacup where the price initially forms a rounded bottom, the cup, followed by a smaller consolidation phase, the handle. The handle typically drifts slightly downward and signals a short-term pullback. When the price breaks out of the handle with increasing volume, it confirms that buyers are in control and a strong upward move is likely to follow. The key to trading the cup and handle pattern is to watch for volume to confirm the breakout. If volume is low during the breakout, it may indicate a lack of interest and the move might not hold. In addition to bullish patterns, you also have bearish patterns that can be identified through price action and volume. For instance, a descending triangle, which forms when there is a support level that the price keeps testing while the highs are progressively getting lower, signals that sellers are becoming stronger. A break below the support level with high volume confirms the bearish sentiment, often leading to a significant downward move. The relationship between price and volume here is key, as a lack of volume during the breakdown can indicate a potential false move or fake out, where the price quickly reverses direction after breaking support. Head and shoulders patterns can also be seen during uptrends as reversal signals. The head and shoulders formation consists of three peaks: a left shoulder, a higher head, and a right shoulder that is typically lower than the head. This pattern signals that buying momentum is weakening, and sellers are starting to take control. Volume plays a critical role here, as increasing volume during the break below the neckline, the support level connecting the lows of the left and right shoulders, confirms the reversal. Inverse head and shoulders patterns are the opposite and occur during downtrends, signaling a potential reversal to the upside when accompanied by rising volume. Triangles, such as symmetrical triangles, are also worth mentioning. Symmetrical triangles are neutral patterns where the price makes both lower highs and higher lows, causing the trend lines to converge. Volume typically decreases as the pattern forms, indicating that traders are waiting for a clear direction. The eventual breakout can occur in either direction, but a surge in volume during the breakout adds credibility to the move and often results in a strong trend. Wedges are another important type of chart pattern. A rising wedge forms when the price is making higher highs and higher lows, but the upward movement is losing momentum as the trend lines converge. This pattern usually suggests that an uptrend is nearing its end, and a reversal may be on the horizon. A falling wedge, on the other hand, is a bullish pattern that occurs when the price makes lower highs and lower lows, but the lines are converging. A breakout to the upside with increasing volume is a strong indication that the downtrend is losing steam, and a reversal is likely. Volume is crucial for both types of wedges, as it helps confirm whether the breakout will have follow-through. Understanding the specific characteristics and volume dynamics of these chart patterns can help traders better determine the likelihood of trend continuation or reversal. By combining volume analysis with these recognizable chart patterns, you get a much clearer and reliable picture of the market's intentions, allowing you to enter and exit trades with more confidence. Similarly, a bull flag with rising volume shows that the brief pause in price movement is temporary and the uptrend is likely to resume. A bull flag forms after a sharp price increase, followed by a period of consolidation that drifts slightly downward or sideways. This pattern represents a pause for the market to catch its breath before continuing higher. When you see a surge in volume during the breakout from the flag, it is a signal that buyers are taking charge once again, making this pattern a reliable continuation indicator. Pennants are another continuation pattern to look for. They are similar to bull flags but have converging trend lines that form a small symmetrical triangle. A breakout from a pennant with rising volume signals that the market is ready to move in the direction of the prior trend, and it is often accompanied by strong momentum. Another powerful bullish pattern is the cup and handle. This pattern resembles a teacup, where the price initially forms a rounded bottom, the cup, followed by a smaller consolidation phase, the handle. The handle typically drifts slightly downward and signals a short-term pullback. When the price breaks out of the handle with increasing volume, it confirms that buyers are in control, and a strong upward move is likely to follow. The key to trading the cup and handle pattern is to watch for volume to confirm the breakout. If volume is low during the breakout, it may indicate a lack of interest, and the move might not hold. Head and shoulders patterns can also be seen during uptrends as reversal signals. The head and shoulders formation consists of three peaks: a left shoulder, a higher head, and a right shoulder that is typically lower than the head. This pattern signals that buying momentum is weakening and sellers are starting to take control. Volume plays a critical role here, as increasing volume during the break below the neckline, the support level connecting the lows of the left and right shoulders, confirms the reversal. Inverse head and shoulders patterns are the opposite and occur during downtrends, signaling a potential reversal to the upside when accompanied by rising volume. Triangles, such as symmetrical triangles, are also worth mentioning. Symmetrical triangles are neutral patterns where the price makes both lower highs and higher lows, causing the trend lines to converge. Volume typically decreases as the pattern forms, indicating that traders are waiting for a clear direction. The eventual breakout can occur in either direction, but a surge in volume during the breakout adds credibility to the move and often results in a strong trend. Wedges are another important type of chart pattern. A rising wedge forms when the price is making higher highs and higher lows, but the upward movement is losing momentum as the trend lines converge. This pattern usually suggests that an uptrend is nearing its end and a reversal may be on the horizon. A falling wedge, on the other hand, is a bullish pattern that occurs when the price makes lower highs and lower lows, but the lines are converging. A breakout to the upside with increasing volume is a strong indication that the downtrend is losing steam and a reversal is likely. Volume is crucial for both types of wedges, as it helps confirm whether the breakout will have follow-through. Being thorough in understanding these chart patterns and the role of volume will help you make better trading decisions. Volume acts as a magnifying glass, showing you the real strength behind a price move. When you combine these patterns with volume analysis, you get a clearer and more reliable picture of the market's next steps. Always pay attention to volume surges during key breakouts or breakdowns, as they add credibility to the move and increase the chances of a sustained trend. On the other hand, if the price is rising but the volume is falling, there might be trouble. This is often seen as a warning sign, indicating that fewer people are interested in pushing the price higher. It means the current uptrend might be losing strength, and a potential reversal could be on the horizon. Think of it as fewer people cheering at a game, making the enthusiasm fade, and as a result, the trend might lose steam. This scenario can also be observed in patterns like ascending triangles where volume fails to pick up during a breakout attempt, increasing the risk of a false breakout and potential pullback. Moreover, volume plays a critical role in confirming the strength of other chart patterns as well. For example, in a head and shoulders pattern, increasing volume during the formation of the right shoulder and during the break of the neckline can confirm the likelihood of a trend reversal. Without sufficient volume, the pattern might not play out as expected, and the price could fail to reverse. Similarly, a double top or double bottom pattern becomes more reliable when confirmed by strong volume at key turning points. When price approaches these levels and volume surges, it is a strong indication that the market sentiment is shifting and a reversal is likely. When evaluating descending triangles or bearish flags, look at the volume as well. If a descending triangle breaks down with high volume, it signals strong selling pressure and confirms the likelihood of a continued downtrend. Bearish flags with increasing volume are also a strong indicator that the trend will continue downward. In all of these cases, the relationship between price action and volume helps you gauge the conviction behind the move, whether it is a continuation or a reversal. Always remember, A pattern without volume confirmation is like a story without evidence. It may look convincing, but the real strength is questionable. What if prices are falling, but you see that the volume is increasing? This means there is a lot of selling pressure. Traders are jumping in to sell, and it confirms that the downtrend is strong. But if the price falls and the volume also drops, that might mean the selling pressure is starting to fade. The trend might be about to change direction. Let us talk about breakouts. Breakouts happen when the price pushes through a key level, like a ceiling that has been keeping it from going higher or a floor that has kept it from going lower. When you see price break through that important level, what do? You look at the volume. If there is a big spike in volume, it is a good sign that the breakout is real. A lot of traders are jumping in, and that makes it more likely that the breakout will hold. But if the volume is low when the breakout happens, it might be a false move. The price might not keep going in that direction. To avoid getting caught in a false breakout, wait for that volume confirmation. Now let us look at how price action and volume can help you spot reversals. Reversals are when the trend changes direction. Have you ever seen a pattern called a double top or a double bottom? These are classic reversal signals. If these patterns happen and you see a big increase in volume, it can mean the trend is about to change. When a lot of traders come in to push the price in a different direction, it is often a sign that the old trend is ending and a new one is starting. Look for these moments and pay attention to how volume behaves when price hits key levels. Here is another tip about reading price action and volume. Let us say you see a pattern like an ascending triangle or a bull flag. If the volume is increasing, that means buyers are stepping in, and the price is likely to continue moving up. This is a strong indication of continuation, as increased volume shows that there is growing interest and conviction behind the upward movement. It is the same for bearish patterns like descending triangles. If volume is growing, it means sellers are getting more aggressive and there is a higher likelihood of a continuation to the downside. Let us expand on some of these chart patterns further. An ascending triangle forms when there is a resistance level that the price keeps testing while the lows are getting higher. This pattern shows that buyers are gradually becoming stronger and pushing the price closer to breaking out above the resistance level. When the breakout happens with a significant increase in volume, it is a very bullish signal. The more times the price tests the resistance level and fails to break below the rising trend line, the stronger the signal when the breakout eventually occurs. A bull flag is another common continuation pattern, which forms after a sharp upward move, followed by a consolidation that drifts downward or sideways. The flagpole is the initial sharp move, and the flag is the brief period of consolidation. When volume surges during the breakout from the flag, it indicates that buyers are regaining control and the uptrend is likely to continue. Strong volume during the breakout makes this pattern more reliable and shows that there is renewed interest in pushing the price higher. Descending triangles are similar but indicate the opposite direction. The descending triangle forms when there is a support level that keeps getting tested while the highs are progressively getting lower. This pattern shows that sellers are becoming more dominant and buyers are less able to push the price up. A break below the support level with high volume confirms the bearish sentiment and often leads to a significant downward move. It is important to watch how volume behaves during the formation of the descending triangle. If volume is gradually increasing as the pattern develops, it suggests that sellers are gaining more and more control, which makes a breakdown more likely. Conversely, if the volume stays low throughout the formation, it might indicate that neither buyers nor sellers have a lot of conviction, and the price could remain in consolidation. Without strong volume, a break of support may not hold, and the pattern could fail. One additional factor to consider is the behavior of the support level. In a descending triangle, the support level is crucial because repeated tests of this level weaken it. The more times the price tests the support without breaking it, the more likely it is that a significant breakdown will happen eventually. The buildup of selling pressure with each test can make the eventual breakdown more forceful, especially when accompanied by a volume surge. Traders also often observe the duration of the descending triangle. If the triangle takes a long time to form, with many price swings and several touches of both the resistance descending trendline and support level, it tends to create a larger buildup of tension. When the eventual breakout or breakdown happens, it can lead to a more substantial move, as market participants who have been waiting for a clear signal finally act. Descending triangles can sometimes exhibit a false breakdown before a real breakout occurs. This is where the price briefly moves below support, potentially triggering stop losses, only to quickly reverse back above the support level and move higher. This shakeout can catch many traders off guard, and that is why volume analysis is so essential. If the initial breakdown occurs with weak volume, it is more likely to be a false move, while a breakdown with strong volume is more likely to confirm the bearish continuation. It is also worth noting that descending triangles can form in both continuation and reversal contexts. In a downtrend, a descending triangle is typically a continuation pattern that signals more downside potential. However, in some cases, a descending triangle can form after an extended uptrend, acting as a reversal pattern when selling pressure overcomes buyer interest. The key in both scenarios is volume. Watching how volume behaves during each test of support and during the eventual breakout will help provide clues about the strength and reliability of the move. For traders, patience is key when trading descending triangles. Wait for a clear breakout or breakdown with volume confirmation, and avoid jumping in too early. This reduces the risk of getting caught in a false move and increases the chance of entering a trade when momentum is on your side. By understanding the nuances of descending triangles, including support level behavior, volume dynamics, and potential false signals, traders can effectively navigate these patterns and make informed decisions. Traders should also be mindful of false breakdowns, where the price briefly moves below support but quickly reverses. This can happen when volume is insufficient to support the breakdown, leading to a quick reversal and trapping traders who acted too early. A key strategy to avoid getting caught in false breakdowns is to wait for a close below the support level accompanied by a volume surge, rather than reacting to the first move below support. Another useful technique is to look for additional confirmation from other indicators, such as moving averages or oscillators, which can help confirm that the breakdown is legitimate. Another variation of the descending triangle that traders should pay attention to is the descending triangle breakout retest. Sometimes, after breaking below support, the price may come back to retest the former support level, which has now turned into resistance. If the retest is met with high volume and the price fails to move back above the support turned resistance level, it is a strong signal that the downtrend will continue. This retest provides an opportunity for traders who missed the initial breakdown to enter the trade with a better risk to reward ratio. Volume is again critical here. High volume on the retest rejection adds further confirmation to the bearish sentiment. It is also useful to note that descending triangles can form as continuation patterns or as reversal patterns depending on their context in the broader trend. If the descending triangle forms after an extended downtrend, it can act as a continuation pattern with a high probability that the downtrend will persist. On the other hand, if it forms after an uptrend, it might signal a reversal. In both scenarios, volume plays a crucial role in validating the direction. If a descending triangle forms after a long uptrend and is accompanied by increasing selling volume, it strongly indicates that sellers are gaining the upper hand and a reversal is likely. Conversely, if volume fades during the formation, the triangle may not lead to a significant move. In summary, descending triangles are powerful patterns that can help identify bearish opportunities, but their reliability heavily depends on volume. Understanding how to interpret volume during the formation, the breakdown, and potential retest of support is key to trading this pattern effectively. Always be on the lookout for false breakdowns and use volume as well as other confirming tools to strengthen your analysis. Another important pattern to look out for is the symmetrical triangle. This pattern forms when the price is making both lower highs and higher lows, which means the market is coiling tighter and tighter. The volume usually declines as the triangle forms, showing reduced activity as traders wait for a breakout. When the price eventually breaks out of a symmetrical triangle, a surge in volume confirms that the market has chosen a direction, and it is often followed by a strong move in that direction. During consolidation phases, volume often drops because fewer traders are willing to enter trades while the price is not trending strongly in any particular direction. When the price finally breaks out of a consolidation phase and the volume surges, it is a strong indication that the market has chosen a new direction and traders are backing the move with increased participation. This volume surge serves as a confirmation, increasing the likelihood that the breakout will lead to a sustained trend in that direction. Different markets call for different approaches. In trending markets, if you see volume rising along with price action, it confirms the trend is strong. When volume starts falling in a trend, it could be a sign that the trend is running out of energy. Be cautious if you are in a trade and volume begins to drop. In a range-bound market, volume spikes near support or resistance levels can give you clues about a possible breakout. When the market is really volatile, pay close attention to sudden volume spikes. These can signal that a big move is coming, whether it is a breakout or a reversal. There are some mistakes you will want to avoid. One of the most common mistakes is ignoring volume completely. If you do not watch volume, you might fall for false signals from price action alone. Another mistake is getting too excited about every little volume spike. Minor spikes do not necessarily mean anything big. You want to see significant volume changes that are connected to important price movements. And finally, do not rely on price action alone without using volume as a confirming factor. Volume helps you see if the move is strong or if it might fade out, so do not skip that extra step. To make your strategy even better, you can combine price action and volume with other tools. Moving averages are helpful. If the price breaks above a moving average and the volume is strong, it adds to your confidence that the move will keep going. You can also use the relative strength index to see if a security is overbought or oversold. For example, if the price is overbought and the volume starts dropping, it might mean a reversal is coming. Another good tool is Bollinger Bands. If the price breaks out of the bands and the volume rises, it is often a strong move. The best way to use these concepts is in your own strategy to decide when to enter and exit trades. Enter trades when volume confirms a breakout or the continuation of a trend. Exit trades when volume starts to fade or when it shows signs of a reversal. Remember to set stop losses just beyond key levels like support or resistance to protect yourself from sudden moves. When volume supports the move, you have the confidence that you are on the right side of the trade. To wrap things up, price action and volume work together to tell you the story of what is happening in the market. When volume rises, it confirms the trend. When volume falls, it could mean the move is losing steam. Watch how these two elements interact and use them to make better trading decisions. The more you practice, the better you will get at reading the market. Stay curious and keep exploring how price and volume relate. Start applying what we have talked about to your own charts and see how these signals play out in real time. If you have questions, thoughts, or things you would like to discuss, do not hesitate to share them. I would love to hear how these concepts work for you.